Hey everybody, today we're looking into the Federal Reserve and trying to understand a little bit more about its history, about how it functions, what its goals and purposes are, and ultimately what are the tools that it uses to help try and influence and affect the overall economy. Now, the Federal Reserve has a great video called In Plain English, which is a little outdated only because the Federal Reserve has changed some of its goals in the last couple of years, but it's still a pretty helpful video. And I'm going to try and put a link to that in the comments section. There's also another really interesting video about the founding of the Federal Reserve, and I'll also put that in the comments. For the purpose of this video, I just want to look at some of the tools that are available to the Federal Reserve, particularly focused on what are known as open market operations and trying to get a handle on how those work. So what are the tools of monetary policy? What are the tools of the Federal Reserve? Well, three of them. One, open market operations. We'll get to those in a little bit. The reserve requirement, and then the discount rate. These three tools together influence the amount of money and credit in the economy, which then affects aggregate demand. And it's this influence over aggregate demand that enables the Federal Reserve to address either inflationary gaps or recessionary gaps. So the first tool is the reserve requirement. The Fed can set the reserve requirement, the required reserve ratio, at whatever level they want. Right now it's at 10%. If banks don't have enough resources or reserves to meet that 10% requirement, they have to borrow it from another bank. If they're going to borrow it from another bank, they enter into what's known as the federal funds market. And the interest rate that one bank charges another is known as the federal funds rate. And that's the rate that the Federal Reserve is constantly trying to influence in order to get banks to either start lending more money and get closer to that required reserve level, or lend less if they want to slow the economy down. If there is no local bank that has the resources to assist a bank that's below the required reserve ratio, then they could go to the Federal Reserve itself. The Federal Reserve is the lender of last resort. And so banks who can't find other banks to lend to them or can't get the necessary level of capital through the federal funds market will go to the bank directly, to the Federal Reserve directly, and borrow from them. But they will borrow at a higher interest rate than they would have paid if they were in the federal funds market. That interest rate is known as the discount rate. And again, that's 1 percentage point above what you would have paid in the federal funds market. Really, the Federal Reserve is acting sort of like parents when their children fight. When kids are arguing with each other and bickering back and forth, oftentimes parents don't want to be bothered by that. They want you to figure it out on your own, and so it's like, when you get into a fight with a younger brother or sister and you go to your parents and you complain about your siblings, your parents sometimes, many parents, my parents, might look at me and say, okay, I could solve your problem, but I prefer if you solve it for yourself. You say, well, they're being irrational, they're being ridiculous, and we just can't come to a solution. And then oftentimes parents say, well, okay, I'll give you a solution, but you may not like my solution. You may not enjoy what it is that I'm going to do to settle your dispute. And that's sort of like the Federal Reserve here. They're saying to the banks, figure it out amongst yourselves, lend to each other, get this thing sorted out. Please don't come to us. We don't want to have to solve all your problems. But we can, but you're not going to like it. It's going to cost you more. And that's the discount rate. Now, the final tool that the Federal Reserve has is known as open market operations. And open market operations have to do with the purchase or sale of U.S. debt. When the government needs to borrow money, it's going to issue what's known as a bond or a treasury bill. It's a piece of paper. It's a promise to pay the person who lent them money. And banks own these bills, and the Federal Reserve owns these treasury bills because they're wonderful assets. The federal government has always paid back its debt, and so it's sort of a guaranteed rate of return when you possess these treasury bills. The Federal Reserve's decision to either buy or sell treasury bills, either buy bills off of banks or sell them to banks, has a major influence in the amount of M1 that's in the financial system, and therefore has an impact on total aggregate demand in the market. A lot of people get confused by the buying and selling of Treasury securities in this course. And so I always try and get you to think in terms of a context you're familiar with. You're a buyer of things. You're a seller of things. At least some of you are. And you sort of understand the concept of selling something to somebody else. And you understand the concept of buying something from somebody else. So try and put yourself in the shoes of the Federal Reserve when it comes to buying and selling T-bills. If the Fed wants to buy T-bills from a bank, the Federal Reserve has to give the bank something in exchange. You have to give something in exchange. You roll up to a Chipotle and want to buy a burrito. They don't just hand it to you. You have to give them something of value. That something is money. So when the Fed wants to buy T-bills from the bank, the Federal Reserve will hand dollars to the bank, and the bank will hand the T-bill over to the Federal Reserve. And so when the Fed is busy buying T-bills, it is taking the asset, the T-bill, away from the bank, but in exchange, handing the bank actual money. And so when the Fed buys T-bills, it's increasing the money supply. It's increasing the amount of M1 in the banks and in the banking system. Because once the bank has this money from the Fed, it wants to lend it out in order to earn itself a profit. And so when the Fed buys T-bills, M1 increases. When the Fed chooses to sell its T-bills, just like when you choose to sell something to somebody else, again, there's a transaction here. You don't just hand somebody something without getting paid. So the Federal Reserve is the same way. They're not going to hand Treasury securities to banks just because they're nice people. They're going to give the banks T-bills because the banks are offering them a price that the Federal Reserve wants to receive. So when the Federal Reserve sells its T-bills, it's sending the T-bills to the bank in exchange for money from the bank. And so when the banks send money to the Federal Reserve, it's taken out of M1. It's taken out of circulation. One thing that I always sort of say is that money at the Fed is dead. That is that it's locked away. It cannot be spent by anybody. It's being held by the Fed out of the system and will stay out of the system until the Federal Reserve chooses to buy T-bills back. Or until the federal government decides to borrow more money, and then the Fed sort of creates it. So when the Federal Reserve sells its T-bills, this exchange of I give you, or the Fed gives you the T-bill and takes money from you, causes the money supply to shrink. This buying and selling, increasing or decreasing money supply process is very important to make sure you understand. So let's do a little bit of practice. Think through what we've discussed so far about the various tools available to the Federal Reserve and think about how that might influence the amount of money in the money supply, the amount of M1. And go ahead and work through this chart, press pause while you do it, and see what answers you come up with, and then press play again and we'll see how you did. If the Federal Reserve wants to increase its money supply, then when it comes to the reserve requirement, it's going to have to decrease the reserve requirement. It has to reduce the amount of money banks have to hold in its reserves. And by doing so, it increases the amount they can lend. And that lending process through the money multiplier, it's going to create more money if you are able to lend more of it. If you want to increase the money supply, then when it comes to the discount rate, same thing. Federal Reserve will want to decrease the discount rate. They want to decrease the penalty that banks have to pay for overlending. And so reducing the discount rate gives banks an incentive to lend more to people. And the more lending you do, the less excess reserves you keep, the more money is created, and the greater the money supply. And then when it comes to open market operations, the Federal Reserve could buy T-bills, because when they buy the T-bill, they're going to take the T-bill from the bank and hand the bank money that the bank can then turn around and lend, which creates, through the money multiplier, more M1. So when they are buying T-bills, they're increasing the amount of money available in the bank reserves to be lent out, and then banks will increase the amount lent to the public, which increases the money supply. The opposite is true if they wanted to decrease the money supply, as you can see. We'll talk more about the sort of buying and selling in particular in class, and we'll work on some problems, and I will see you there.